there's been a day of reckoning coming, and it's somewhat been delayed last year as the Federal Reserve got a little bit more dovish in their tone, that people thought maybe interest rates were coming down. But I think the industry has now gone through its 5 stages of grief, and they've gone past the denial and are now at acceptance. And so a recognition that rates aren't going to come down, and so it's not going to be some saving grace, and so they have to deal with these challenges. So now the banks, the institutions are busy, taking the appropriate marks, taking the appropriate reserves, and now we're going to have to start going through the process. It's a big problem, right? There's $1 trillion of debt that's coming due this year, $2 trillion over the next 3 years, and most of this debt has been financed at interest rates that are not normal interest rates, right? They're interest rates that were much lower for the last 10 to 15 years that aren't going to come back. Now we're going to have more normal rates. So we have to go through a re-equitization. Means that there's going to be pain on the equity side, pain on the debt side. You saw today there's an announcement about U.S. pensions having to take more write-offs on the commercial real estate. We've seen more banks having issues. I think that's going to happen as well. So we're just in the beginning now of facing this challenge, and it's going to be something that's going to work its way through this year and into next year.
All right, so let's just say I've got a building in Midtown, wherever. I'm part of that $2.2 trillion that's coming. I go to my bank. The interest rate's much, much higher. The value of my property is 30, 40, 50% lower. I don't know, something along that magnitude. You only loan to value 50%. Something's got to give there, right?
Exactly, right. So, I mean, I think, and again, this is different than like the 2008 crisis, right? When 2008 came, there was this injection of capital that really sort of lifted all values, right? In this case, we have a structural period between the interest rates, and then some types of properties aren't going to be competitive. So you referenced an office building today, right? And then that commentary. Office not only has the revaluation because of interest rates, but people use office buildings differently, and some buildings are going to be competitively obsolete. So you have to pick the spots correctly, and then you have to face that reality. So the bank has to adjust its loan. The equity has to write off the equity and inject new equity, and you have to pick which buildings are going to be successful in this post-pandemic world. I think the other piece of this is multifamily, which I think to me is more of the Achilles heel for the broader regional bank because there's a heavy concentration of multifamily in the regional banks around the United States. They have something like 50 to 60% of their book of business is loans. And those loans, even if just from an interest rate, even if credit is good, is underwater today, right? But now you also have new supply coming into the market. So there's going to be a couple of years of headwinds on that multifamily market that I think is going to put a lot of pressure on these regional banks going forward.
So when there is pressure, are you a buyer? Are you a seller? What do you do?
Yeah, listen, I think these could be a generational moment of time to be a buyer, right? And so we're active in the market, but you need to be very selective, right? It's not just about having the capital. You have to have the capabilities to choose which of the properties that are going to be successful. You need to bring down the basis, so you're not going to do this and think values are going to come back. You're not doing this on a bet that interest rates are just going to fall and everyone's going to do well. So you have to find a way, how are you going to create value? And you really can't be necessarily try to time the top or the bottom, right? So we had a company that we sold in January of 2007, and we didn't know it was the top, but it felt frothy, right? So we sold it. We came back in the market of August of 2009. We didn't know where we were in the cycle. It just felt like the right time to enter. So moments like this is where you want to start entering before the all clear signal is sounded, but you got to be very selective, but know that there's a lot more trouble to come that's going to create more distress in the system.
Scott, do we have a housing shortage in this country? And if so, how did we get there?
Yeah, we definitely have a housing shortage in this country, and it began to transpire after the last financial crisis, right? You ended up being in a situation where, the ability to build new housing became more challenging. People were more conservative. So there's, estimates of about 6 million units of shortages of housing in this country. And now, because of what the low rates during the pandemic, you've had this incredible amount of people buying homes, financing long, so existing home sales aren't trading. So we have this weird anomaly. While interest rates are up, housing prices have stayed strong, and the market hasn't really weakened in that regard. And so, it's going to exacerbate the problem, right? Because now if you have less construction, as we get to 2026, you're going to have less housing today than you have the demand for housing.
So when you're getting the feeling that, there's distress, it's time to buy, even though there'll be more distress later. How do you get that feeling? Like, is there a screen that you look through to make sure, like, okay, not that property, but yes, this property, even if they're like right next to each other or something? Like, how does your brain work with that, Scott?
Yeah, no, I think you got to be very concrete and have, and screen's a good word, right? We have formulas. So like for office as an example, we created something called Project Kodak, and we said some buildings are going to be digital, that are going to be successful in the post-pandemic world, and some are going to be film, and they're not going to be successful. And we said, okay, we want to invest in digital, and we put the whole set of criteria as to what is digital. And those are the properties that are digital.
What is digital?
So digital are buildings like this Bloomberg building, right? Which are, have places where people can collaborate. They want to come to work because you can engage with people. They're in good communities. They're easy access from public transportation. And so that is something that ultimately will be successful of attracting people. And so you need digital buildings, but they still may have broken capital structures. So our objective on investing is identify the digital buildings with the broken capital structures, invest in them, fix the broken capital structures, and when you do that, you see the leasing. Like last year, we leased 2 million square feet of space. This year, so far we have 1.5 million square feet of leases out, right? So if you have the right building with the right capital structure, there's a lot of tenants that want to be there.